Peter, thanks very much for joining us on day 2 of Global Offshore Wind. How are you?
I'm good, and it's very good to be here.
So you are fresh from a presentation earlier on today. Can you tell us a little bit about that and what it means?
Yeah, so I was presenting at the Vestas Innovation Theatre, just over to the right, and we were talking about cost inflation in the offshore wind industry, essentially. What we have done at Westwood is we have done a sort of a market survey, market study of our key industry contacts to essentially go out and answer those key questions. Cost inflation, how much is it in quantifiable terms? What are the things that are driving it, and what are the effects on the industry overall?
So what are the headlines as far as the presentation is concerned?
So I think in terms of major headlines, I'd say the amount of cost inflation is about 11 to 20% that most companies have been seeing since 2021, but there is a range in that, some seeing less, some seeing more, and of course within that there are specific factors. So materials, people are seeing them go in some cases up by more than 40 to 50%, the same on the financing side, vessel charters, similar things. So a range of things driving offshore wind cost inflation. And it is coming from the big factors, so it's the commodities, it's the vessels, it's the financing.
This is a global problem, not just a UK and European problem.
Absolutely. I think inflation is something that we're seeing everywhere in the world, with perhaps a few specialist exceptions, like maybe China. And of course, if you think about a global supply chain, everybody's essentially playing and buying into the same companies, looking for these same materials. There's a global steel market. If you need to get steel from somewhere and the price of steel's gone up, you can see the problem that now that will flow through to projects everywhere.
Okay, so that's the problem. In terms of the solution, are the government are they talking about doing anything in terms of their subsidies, or what do you see happening?
Well, I'm not sure government is the right way to go for this, but we have seen some projects essentially say we're going to slow down, we're going to review our position, we're going to think about, so this is our project viability, now our prices have gone up by 30%. What does that do? Is the return good enough to justify us going on? We've seen in some cases actually organizations, a few in the US for example, a few project developers, for example the South Coast Wind Farm, saying look, we agreed to build this with a certain offtake price, but look what's happened in the past few years, we can't afford to do this anymore at this particular level, we're going to try and back out, we're going to go in again, we're going to try and re-tender, we'll get a level that we think is actually can be supported. And it's not cost-free doing that. South Coast I think is paying potentially in several tens of millions of dollars to get out of their initial offtake agreement. But again, if you've seen the internal rate of return on your project absolutely crash because your costs have gone up by 50%, you have to think, well, is it worth taking a smaller hit now to actually get something that we think can work overall?
Absolutely. I think real-world challenges, moving those project execution dates back further. And we're hearing a lot about that here at the conference today. So thank you very much for your insights. And we wish you a good rest of the day.
Same to you. Great to be here.